Hey everyone, it's Conrad Bobbylack here, CEO of Investors Prime Real Estate and best-selling author of Australian Real Estate Investing Made Simple. Welcome to today's video. Today's video is very cool because the timing couldn't be perfect. I know a lot of you out there will be looking at entering the market, and the market was supposed to crash during COVID-19, which it didn't. It was interesting because I went back through some of the old videos that I did on YouTube in 2018 and 17 and 2019 at the beginning of COVID-19, and also two videos during COVID-19 when I was talking about the market direction and where Melbourne was heading. And in all instances, I was actually saying the market's going to boom in 2019 and 2020 and 21, irrespective of COVID-19, because of the key fundamental driving factors that were in place. Despite that, everyone else, well, not everyone else, but a lot of people disagreed with me. A lot of economists, a lot of so-called professional experts, self-professed gurus on YouTube were talking about Armageddon, blood on the streets, devaluing properties, people losing everything. The funny thing is that when you look at the crypto market or the stock market, no one rejoices when there's a correction, or when Bitcoin is falling, losing 20, 30%. But in the real estate market, in the property market, it's always where there's a small minority group of people that would love to see it all come crashing down and, so everyone will lose everything, which is a bizarre concept, right? It's almost like they wish that the market would crash. And I think it's because they haven't got properties, or they haven't got properties in areas they want to live in. So there's a kind of jealousy or something about people that have properties. It's a bizarre concept to me, because I would never rejoice in anyone losing any money in anything, no matter what market it is, if it's bond market, commodities market, cryptocurrency market, foreign exchange market. I mean, when the market has a correction, I don't sit there going, yeah, you cryptocurrency traders, or yeah, you forex currency, take that, yeah, you ruble holders. It's so bizarre, that there's this group of people that would love to see the property market crash. And you can see it in forums and I randomly, most of the time I don't even check these things because I don't have the time. I'm kicking back, either holidaying with the family or enjoying life. I don't really listen to naysayers. The problem with negative people is they have a solution or a problem for every solution. So it's something that I don't really care to explore. The thing about it is, when you're listening to people and getting advice from people on the property market, especially on the YouTube, look back through the history of what they were saying 3 years ago, 5 years ago, and during COVID-19, because I can tell you now, a lot of people on YouTube were saying the market was going to crash during COVID-19 because, Conrad, how can it possibly go up? The economy is going to stall, there's going to be massive unemployment, blah, blah, blah. It's all bullshit, okay? So those people that said that were wrong. I was right, because I was saying the market's not going to crash. In fact, I'm going to play you a segment of a YouTube video that I did back in 2018, talking about the suburbs that are going to be booming in Melbourne, and I was 100% correct. So track record is everything. I've got now videos going back 6-7 years on my YouTube channel. Eventually it's going to get to 10 years, which is one whole property cycle and probably more. So, be careful who you listen to, number one. Get advice from people that only have results, but also have a track record of getting things correct. That's my advice, basically. That's what I'm trying to say. Today's video is about apartments versus townhouses versus house and land. In the Melbourne property market specifically, I'm going to give you my views about apartments, about townhouses, house and land, different suburbs, where to invest, where to stay away from, and which is the number one vehicle for wealth creation. Bit of a personal disclaimer. I have never met you in person. I don't know your set of financial circumstances, and I haven't considered any of your circumstances. And then nothing that I'm talking about today constitutes as any financial advice. So basically, it's just purely for educational purposes only. There's no guarantees in life. And past performance doesn't guarantee future performance. The only thing I do guarantee is that if you take no action, you're going to end up dead broke at 65, like most Australians. Asset rich, one house paid off with no income on the pension. And I'm telling you now, you're not going to have a happy life. Look what's happening now with inflation. The cost of living has just gone through the roof in Australia. I mean, it's crazy. Petrol prices, everything, food, milk, bread, fruit, everything's going through the roof. It's crazy. My background, for those who are not aware of my background, I won't bore you to death, but I've wasted 4 years of my life at Monash University drinking beer at the tavern and shooting pool and doing assignments with international students. Nearly did an MBA, more bad advice, but I didn't, which is great, thank God. I'm a real estate agent, I'm a mortgage broker. I've spent most of my life in the corporate financial services sector, financial planning, and also dealing with commercial lending, asset finance for NAB and Medfin. So my background is very kind of structured, very boring background, but also the most important thing is, and this is the only reason why I'm talking to you today, guys, is because I'm a real property investor in Melbourne right now, sourcing properties, investing in the market. So I've got my finger on the pulse of the market, and this is what gives me the right to talk to you about and share this information with you. By the way, I have no agenda about this information. I'm not a developer selling my own stock, or I'm not trying to make a suburb look better than it is. It is what it is. The market is what it is. And I'm here to make money, and I'm here to teach you how to make money and share some ideas with you, so hopefully you won't make mistakes. Also, I'm an author of Australian Property Finance Made Simple. You can get a copy at any good bookshop, Amazon, or just jump on my website. Thank you guys for making it #1 on Amazon as #1 bestseller. And also, my second book, Real Estate Investing Made Simple, also you can get on my website. Also went #1 multiple times on Amazon. And the funny thing is, whenever I'm #1 in Amazon, the other book also creeps up in the top 10. And I've had situations where I've been #1 and #2 in various categories, which is really cool, pardon me. Bit of a recap. I have to mock experts who get things wrong before I get into the educational part. The end is nigh, right? The market's going to crash. Roll back 2019, COVID hits, we're going into lockdown. June 2019, we're in the midst of it. Everyone's locked down. It's misery, right? I'm cool. I'm on my big compound in the eastern suburbs, kicking back in my pool, doing powerlifting. I've got a home cinema room. I've got a really good coffee machine. It doesn't really impact me at all. But the whole market, people were really concerned about what's going to happen. Is the market going to crash? In fact, it did really well because people had tree change and sea change. Those with resources upgraded their dwelling. And because their proximity to the city no longer became important because you could work from home, so there's no reason to be in Richmond or places like that, which are very good for investing money, but are absolutely terrible to live in. And I worked in Richmond in the X building, 534 Church Street, Richmond, for 2 years. So I know how terrible the area is. I mean, unless you're like heroin addicts walking around and people on ice all day long, it's a great area. Yeah, fantastic. Not. Bricks and mortar story. Remember, 16th of September 2018. The market's going to crash by 40%. And what about all the other articles? Right? Because people have a very short memory. Bloodbath, Great Depression, 50% property market crash in Australia, unsustainable. CBA warns risk of 32% property house crash. Everything's crashing. And what happened? The most embarrassing thing happened that I could imagine. The market actually had a 33-year price hike, and it hit the highest price growth in 33 years. In fact, for the national average, and this is December the 31st, 21, this is for the national average, we did 22.1%. So think about how wrong people were. And I'm not talking about investors here, I'm talking about so-called academics, economists, people who supposedly know what they're talking about. You got to understand something, guys. I've got a lot of letters behind my name. I've done a lot of courses. I'm a bit of a nerd when it comes to courses. I love doing courses, right? Because someone's an economist, it doesn't mean anything. It's just an old guy that went to some TAFE or uni, sat there, did assignments, little assignments with other people, and got his piece of paper at the end. It doesn't mean anything. It doesn't have any credibility in the real world. There's no money. These people were dead broke. They got no idea what they're talking about most of the time. It's just all theory. The people you got to listen to are people that are making money in the market. That's who you need to listen to, right? Not some theorist that did some course 20 years ago. He's got a piece of paper and he's an economist. So this is, and you know what? The proof is in the pudding. Just look at the results. Look what they were saying 2 years ago. Look what happened in reality, right? Sydney did 25.3%. Melbourne, 15.1%. Brisbane, 27.4%. Adelaide, who cares, right? No one. Well, Adelaide did 23.2%. That's a phenomenal result. Don't hate me, Adelaide people, okay? Perth, 13.1%. 28.1% to Hobart, right? All the people left Melbourne, went to Hobart to live because it's really cheap and beautiful, right? Darwin, 14.7%. Canberra, 24.9%. So, you know, we had a national average of 22.1%. What happened? What happened, guys? What happened to all the bloodbaths? All the crashes? I mean, to me, it's hilarious. You know, I don't pay attention to these people. You know, you look up their credentials, they're just some guy that did an arts degree, journalism. I know about property, the median price. I know what a median is. It's insanity. It's complete insanity. And to me, it doesn't affect people like me because I'm making money. I make more money in a downturn market than a trending upwards market because then they can buy cheaper, negotiate better terms and conditions. The reason I don't like it, guys, is because it's affecting the mindset of people trying to get into the market, the 18, 21-year-olds that don't understand anything and they think, oh, this professor's saying the market's going to crash. Maybe there's something to it. No, there isn't. Anyway, enough about that. What's happening now is data is showing us two things. Number one is property investors are back in a big way. Look at that, bang. So this is refinancing is the light blue line, December 21. So people are refinancing because interest rates are going to go up. Inflation is record high now, the highest we've had in 20 years. RBA is going to definitely increase rates by 25 basis points or even half a percentage point. Probably not next meeting, but the meeting after. It depends who you listen to. No one has got a crystal ball. But definitely people are refinancing, getting equity out, buying more property, and also fixing their rates. That's why the refinancing is happening. But also if you look at owner-occupiers, they've gone in hard as well because they had a tree change, sea change, upgraded houses, especially the most expensive properties. So in Melbourne, you're looking at 2 million to 3 million. That market really just skyrocketed. People were sick of living next to the city in small properties like in East Melbourne, North Melbourne, Richmond, you know, those areas. And they thought, well, I could get a big mansion in Templestowe or Eltham. And they moved out, basically. That's what happened. Not everyone. Investors are going in hard right now. They're buying up properties because they can see, well, the market didn't crash. COVID's nearly over. It's going to be old news 5 years from now. Right? Like the foot and mouth disease and all the other viruses we've had. Yeah, it was bigger than anything else we've had. Absolutely no argument from me. It did have an impact, a permanent impact that disrupted the economy, lifestyles. Even my job in the industry was changed forever with the Zoom meetings that we're holding now, which is a standard thing. Everything's digital, basically. Yeah, absolutely. But the market didn't crash. That's the point. The market had surged and people made 30-40% in the last 2 years in key suburbs in Melbourne. I'm going to show you those suburbs. It's been crazy. So the ones that capitalised on this was fantastic. I mean, I was just sitting back at home looking at my portfolio going up hundreds of thousands of dollars, eating popcorn and listening to all these negative news going, you guys are just idiots. It was hilarious. You know, it was just hilarious. So what's happening right now is that investors are going in record high. So investors are going in hard right now. These are people that know what's happening. But remember, the smart money always goes in at the bottom. But it's a minority of people. So is it a good time to buy property today? Yes. It's like saying, when's a good time to go to the gym? Well, let's say, why do you want to go to the gym? Oh, because I want to get healthy. So are you asking me, when's a good time to start getting healthy? Now. So when's a good time to start investing in real estate? Why do you want to invest in real estate? I want to become wealthy. Okay, or financially independent. Now, yeah. When was the best time to buy property? 100 years ago. You know, it's like saying, when was the best time to buy Powerball? Well, you know, last week if you knew the numbers. It's a redundant question. Now, from a timing perspective, we've had record growth the last 2 years. I don't see that happening again in the next 2 or 3 years. I see very strong growth because we're going to have 160,000 migrants coming to the country, but I'm not seeing that same growth of 30-40% that we've had, that stampede of people selling up houses, A-grade houses, so, you know, 2 million plus houses, and buying houses 30-40K from the city, because now they can't live in a 2-bedroom house in Richmond because they've got to work from home and they've got 3 kids and they need 6 bedrooms. That's why they moved. And they can move, and they did move. Now, once they've moved, it's over, you know? And places like even Mornington Peninsula in Melbourne has skyrocketed in price because people just went, wait a second, I'm a lawyer, I don't need to be in Richmond anymore or Elwood. Let's go out to Mount Martha, you know, and get a waterfront property because I only need to go to the office once a week or once a month. And I don't blame them. Unemployment rate is very fragmented. As an investor, when you're buying properties, you've got to be very discerning about what's happening in Melbourne. First of all, there's no such thing as a Melbourne property market. You know, people ask me what's happening in Melbourne. Melbourne doesn't exist. Melbourne is Toorak and St Albans. Okay, it's $12 million, 800,000. So forget about this word Melbourne property market. There's 8 different markets in Melbourne. They're all doing different things, and there's a clustering of demographics. So people are living together based on the same wage and income in suburbs. Everyone wants to live in Brighton on the Golden Mile or in Toorak in a big mansion. Like if I went to every house in Melbourne and said, hi, you're living in Bentley, your house is worth 1.2, I'll give you this $15 million mansion for free in Toorak. Would you want it? Of course, everyone would upgrade, okay? Best schools, security, prestige, and size of the dwelling, okay? There's no question about that. It's a question of affordability, okay? Everyone wants to drive a Mercedes-Benz if the cars are free, okay? But no one can afford one, and there's only a few people that can drive them. So let's be real, guys. So when you're investing, you got to pick your markets, and you can see there, you have very distinctive markets that are separated from each other. They have no correlation between each other. So the people that live in Brighton don't really care what's happening to people that are living in Point Cook. Those worlds are very much completely apart from each other. They have different concerns, they have different economic pressures, different realities, you know. Most of these houses in Brighton are paid off. Most of the properties in Point Cook have borrowed 90%, 95%. Very different people, very different industries, very different concerns. So you've got to look at, for example, now, where is the highest unemployment rate in Melbourne? Because ultimately, unemployment rate leads to mortgage stress, which means mortgage stress by definition is people that have fallen behind 3 months in arrears with their mortgage repayments, therefore their house can be technically repossessed. Now, if that happens en masse in the suburb, then you're going to see properties being fire sold, and therefore it will devalue your property. Now, some will argue that's a good time to get into the market. I disagree, okay? I think you should never touch those areas at all, okay? Unless you want to live there for emotional reasons. But if it's a purely investment decision, you want assets that are stable, that are going up consistently. You don't want assets that are extremely volatile. So if you look at, for example, Northwest unemployment rate 6.8%, where if you look at Southeast unemployment 7%, where if you look at inner South 2.7%, you know? So you have different considerations. So basically, what I would recommend is investing in areas which have the lowest unemployment rate potential because they have the safety and security of stability. So now is a really important time because as interest rates go up, you're going to see a lot of mortgage stress in Melbourne, in the fringe suburbs. And these are predominantly first home buyer suburbs, or what we call nappy valleys. You know, couples with their first child. We call them nappy valleys because there's a lot of nappies on the rubbish tip. So we call them nappy valleys. But anyway, so stay away from areas with high unemployment and focus on areas with low unemployment when it comes to investing. I'm not talking about to living, guys. I'm talking about purely about investing. Houses in some suburbs of Sydney, Northern Beaches and the Gold Coast have doubled every 3 to 4 years in the past decade. Have doubled every 3 to 4 years in the past decade. 3 to 4 years in the past decade. fueled by low levels of stocks and growing number of affluent buyers, data from suburban trends shows. The more expensive housing markets within the median price above 2 million has also outperformed, gaining 13.3% each year on average in the past 10 years. See, people think cheaper properties have greater potential for growth. Not so. Very untrue. See, a lot of this stuff is counterintuitive. You've just got to check the facts. The reality is the $2 million plus properties have outperformed all other sectors of the market in the Gold Coast and in Sydney's northern beaches suburbs, right? 13.3%. This is more than twice the capital growth of 4.8% posted by affordable end of the market within the median price under 500,000. So a lot of project marketers, a lot of people that are pushing house and land packages will tell you, well, these are really cheap properties for the average Australian. But what does that mean? It's just bullshit language. Do you know what I mean? Cheap properties, average Australian. Is that a good thing or a bad thing? And what is the average Australian? You know, tell me what they look like. You know, what background are they? Are they Greek, Italian, Polish? Are they native? You know, what the hell? People just say this stuff. It's just nonsense. And, you know, being Eastern European, our language is very specific, right? And when I make my videos, I'm very specific about invest here, don't invest here. This is good, this is bad. I like those terms. I don't like ambiguity, right? And a lot of what you're going to see the next 3 years, as the market recovers from COVID and a lot of project marketers go back into the industry, selling house and land estates and apartments, they're going to be using very ambiguous terms. You know, this is going up, this is the good, this is that. And most of it, you got to just be discerning and cut through to the essential numbers, because it's all about numbers, guys. That's all it is. One market's growing at 13.3% each year, average over a decade. The other one's growing at 4.8%. If you have limited resources, where would you park your money? Would you like to have a return of 13.3% compounded every year, or 4.8%? That's the question you got to ask yourself. This is why I do these videos. Number one, to teach you how to become discerning, how to, you know, cut through all the bullshit, quite frankly, that's out there. Number two is not to make mistakes. You know, save you from making mistakes and invest in areas that underperform. The number of Australian ultra-rich individuals with a net worth of US 30 million, which is 40 million Australian, give or take currency fluctuation, or more, surged by 124% over the last 5 years. And they have allocated nearly a third of their wealth to their homes or second dwellings during 21, according to real estate agency Knight Frank. The rich are getting richer. The rich went in hard during COVID-19 because they were buying undervalued assets, you know, which is a smart thing to do. Remember, at the bottom of the market, the greatest transfer of wealth in real estate happens at the bottom of the market. And it's a transfer of money where the money flows from the uneducated to the educated. That's all it is. It's not about whether you were born with a silver spoon in your mouth, whether you were educated, whether you're a high school dropout. It's just about whether you have the education in this specific area. It's like anything. Property is the same as dealing in cars, dealing in watches, dealing in stamps, dealing in coins. You either know the market, you know which coins are good, which coins are not in demand, which coins are not performing well, or you don't, or you're theorizing. You know, all the coins are the same, you know. So it's the same with cars. Some cars are hot at the moment and they're going through the roof. A lot of classic cars are going up in value. And some cars are doing nothing, you know, no one wants them because of various reasons. So there's nothing special about what I do, guys. It's just that I'm in the market every day. That's all it is. Because this is my job. I source properties for investors, you know. So I'm like a car dealer or a watch dealer or, you know, someone that's dealing or antiques. And people like me know what's happening every day in the market. We can see the trends. We can see the demand for different things. And all you got to do is find people like me and learn from them and then just copy, you know. Copy and you get the same results. If you look at the greatest growth in the last decade in Australia, look at Maine and New South Wales, 21% growth. If you're looking at, obviously we're here to talk about Melbourne, so Bayside, Melbourne, 16% growth on average in the last 10 years, 16%. per year. And then the second area is Burundara, which is the eastern suburbs, 10%. Now, which areas do I only source properties in at Investors Prime Real Estate? Bayside and the eastern suburbs. Bayside and the eastern suburbs, 16%, 10%. I don't source in Point Cook or Truganina or Pakenham or Berwick. Nothing wrong with those areas. By the way, when you ring me, don't say, I live in an area you don't like. I have no emotional like or dislike to Berwick or Pakenham. I'm completely neutral. It's like saying, do you like Amazon? I have no feeling towards Amazon one or another. It's just a company. And if it's making me money, I'm a big fan. If it's not making me money, I'm not a fan. So I would never invest in Berwick and Pakenham because they're too far from the city. There's too much stock around and the incomes per household are too low to create any kind of pressure on prices. Will you lose money in Berwick and Pakenham? No, you won't lose money. The funniest thing is when people ring me and say, I've watched your video and I bought in Point Cook and my property went up by 8% last year. It went from 500 to, let's say, 600,000. Yes, but Toorak went up by 45%, you know? And so it's always opportunity cost of holding one property versus another. So yeah, it's hard to lose money in Australia. Like you really have to go to mining towns or regional towns with diminishing population to lose money. If you stick to the major capital cities, even on the fringes, as long as it's land, you won't lose money, but it's about maximizing returns. See, you can't afford to make 4 or 5% per year, guys. You won't have enough time to get the compounding effect to replace your income. You need to be buying assets that are giving you 8 to 10% growth per year. And this is why I'm making my videos on my YouTube channel, is to show you where are the suburbs in Melbourne that are performing at 8 to 10% growth per year, consistently long-term, not short-term, some abnormal thing that happens, long-term, 10 to 20 years, and also give you clues about how to identify those areas based on key drivers and fundamentals, because they're very common to those areas. Australia's 10 most expensive suburbs for 21. So you have Bellevue Hill, annual growth 14.7%, 5 years 54.6%. Vaucluse, 16.7% annual change, 52.7% 5-year change, right? So these properties double less than 10 years, right? Bronte, 55.1, 75.4 over 5 years. Toorak, which is the most wealthiest suburb in Melbourne, has the greatest concentration of millionaires in Melbourne compared to any other suburb. 12.4% for 12 months, 45.7. Palm Beach, 29.7, 111.2% over 5 years. Mossman, right? 16.3% for 12 months, 49% over 5 years. Rose Bay, 19.6, 36.5. Now remember, this is for detached houses. This is the medium price. Other smaller properties in Rose Bay, can you get duplexes? Can you get townhouses? Yes, absolutely. And see, there's a spillover effect between houses and townhouses, right? Not necessarily apartments, though. Apartments are a different product. Northridge, 22.5, 53.8. Manly, 37.2, 50.1. And Killara, 35.7, 55.3. So you can see that these are the most expensive suburbs. So don't think the rich are losing money. The rich are getting richer at a faster rate than anyone else in the economy. And the gap between the rich and the middle class is widening for the first time. And the gap between the middle class and the lower class, or the poorest class, is widening as well. And it all comes down to real estate and ownership of property. Guys, you have to own real estate. Even if you buy a house for $60,000 in some regional town with 500 people, it's better to do that. Probably that's a bad example, but it's better to do nothing, because at least you're going to get, even if you get 2 or 3% growth, which is inflation, which you will in regional towns, remember that's $3,000 to $4,000 to $5,000 per year that you're getting on a $100,000 property. You're leveraging yourself. The sooner you start leveraging yourselves, the better you'll be. Renting for life is not an option in Australia. It's going to be unless you're a business owner or an entrepreneur, absolutely, I have a lot of friends that are entrepreneurs, own companies, and they rent penthouses in the city, and they're really happy, and they have no interest in real estate at all, but they've got a business with millions of dollars, and eventually they'll cash out of it, and they'll be, it's game over. But if you're an employee, trading time for money, owning real estate and shares is your number one priority, and you just got to get educated and you know, cut through all the white noise. The other thing that's happening right now, you've probably seen on the news, which is very interesting, is there's a critical rental shortage in Melbourne, which I predicted, and I was telling people there's going to be a massive critical rental shortage in Melbourne in key suburbs. And people are sleeping out in cars, and they're in trailer parks and on the beach in tents because they are getting evicted from properties because landlords are renovating them or moving back in. And then they're fighting for with 60, 70, 100 other applicants, and they just can't get back in the market. So at the moment, there's a massive critical shortage of rents. Now, what happens with a critical shortage of rent? Rents go up in terms of pricing. Now, not every suburb has the same ability to increase rents. So, for example, if you're in Richmond, which is the highest disposable income per person in Melbourne, I actually think Richmond is the best in... Richmond is a funny thing. From an investment perspective, I think Richmond is one of the best, definitely top 5 suburbs in Melbourne. In terms of livability, you couldn't pay me to live in that filthy suburb. I mean, it's a filthy, dirty little suburb, you know, with housing commission, people spilling out onto the streets. Every playground has heroin syringes everywhere. I mean, it was, and people don't believe me. The building that I used to work in when I was a Medfin, which is 534 Church Street in Richmond, which is the X building, in the car park, when I used to drive in there Monday morning, there used to be syringes everywhere and spoons because people were shooting heroin over the weekend and taking ice. And that was just a daily occurrence. And I don't even know how to get through those little doors because there's security everywhere. So it's a filthy suburb, great to make money. And see, I like the suburb because to me it's a money-making agenda. I don't like the suburb aesthetically or in terms of who lives there, you know. And that's what you got to do. You got to separate the emotion out of the investment equation. This is a great thing for people who are on average incomes and you've bought that one townhouse and you're maxed out. Well, what's going to happen with your property is you're going to get 20, 30% increase in your rental, which means your rent is going to fuel your ability to buy more property. So those who bought 3-4 years ago are going to be laughing all the way to the bank because you're going to be able to refinance and go again very quickly when your property manager increases your rentals. Because remember, when it comes to your serviceability as an individual, and I'm just generalizing here, you can watch some other YouTube videos that I've done on finance. If you take 100,000 of your job income that you work for, the banks only take 30% of your job income, which is 30,000 if you're making 100 grand a year, towards all debt repayments, right? That's called the DSR ratio. But when you have 100,000 coming from your rental, they take 80,000 or 80% of that towards your serviceability. So rent is 3 times nearly heavier in the serviceability equation compared to your job income. Because with your job income, you have taxes, living expenses, insurance, all the other stuff. With rental income, you've got a couple of deductions and the rest goes back to the landlord, right? So to cover loan repayments and everything else. So basically the whole fuel behind property portfolios is not your job income. Your job income is just to determine what your maximum borrowing capacity is. But the amount of properties you can buy is your rental. Because every time you buy one, you get rental. And the stronger the rental and the stronger the rental appreciation, the quicker you can go again and again. So that's why I'm sourcing properties, not only that are, absolutely cash flow positive and they're in growth areas, it's the increase of the rental, the ability of you as the landlord to increase your rent on your property without offending your tenant. That's what I'm looking for. I'm not looking for suburbs where you can increase just at inflation, which is 3 or 4%. Traditionally, now it's much higher, obviously jumped up, but I'm saying traditionally, I'm looking where you can go way above inflation, 5, 6, 7% increase per year. That's the suburbs that you want to have if you want to buy multiple properties. That's a very key distinction that a lot of investors are not aware of. Now, let's get into it. Apartments versus townhouses versus house and land. What should you buy? What should you be staying away from? Apartments, complete disaster. Stay away from apartments. Do not buy any apartments in Melbourne or Sydney in the next 10 years, guys. You're going to be sorry you did. You can buy them, and even if in the best suburbs in Melbourne, Surrey Hills, you know, places like Hawthorn, Canterbury, Camberwell, Blackrock, you know, where apartments do really well, they do 5-6% per annum. So you won't lose money, you just won't maximise your returns. Now, having said that, if you want to live in the suburb and you can't afford a detached house, let's say you love Black Rock, you love cycling, you love having coffees on the beach road with other Black Rock cyclists in their special outfits, because you have to have special outfits when you're a cyclist. You can't just wear shorts because then you're just a pleb. You've got to get matching, I don't know what the material is that I do powerlifting, but the matching everything, with special matching codes, and have that little cappuccino. I love it. I completely get it. Black Rock properties, houses, 2 million plus. So if you're going to spend, for a two-bedder, you can still get in for 650, 700. Yeah, absolutely. Good decision. But don't expect high capital growth. That's what I'm saying. One type of property has barely gone up in value despite Australia's record housing boom, and it's a lesson for every first home buyer. One-bedroom apartment prices hardly rose in 21 despite the property boom. Melbourne's median unit price for one-bedroom flat unchanged for $395. Guys, buying one-bedders is like trying to sell ice to Eskimos. No one wants one-bedroom apartments in Melbourne. The market is oversaturated with them. I don't care how big they are. Even if they've got a study, car park, 2 living areas, it's irrelevant. Do not buy one-bedroom apartments. It's a disaster, They keep building them, God knows why. Now, even 2-bedroom apartments, in Sydney it's a little bit different because Sydney is so expensive, right? It's so ridiculously expensive. Most of the suburbs in Sydney, in the North Shore and the Bayside area and the eastern suburbs, that you have to live in apartments. And that's why they do 6.6%. But that's really 6.6 where, for the last 12 months, the Sydney has done, 20%, whatever it did. So you're not maximising the return on your money. One-bedroom flats in big cities have missed out on Australia's property boom despite the interest rate being record low. And this is in Mascot in Sydney. Because of this Mascot Sydney situation, there's going to be a massive inquiry into apartments in terms of construction standards and building standards in Australia. And that's going to put a really big detrimental effect on capital growth from a consumer sentiment perspective. And also, banks are going to restrict lending on apartments in the future, LVR restrictions. G and QBE are going to restrict a lender's mortgage insurance. The LMI will be an issue. It's a disaster. 2-bedders as well. Even if it's 2-bedroom, 2-bathroom, don't do it. If you are going to do it, buy a 3-bedroom. That's the only property. I still wouldn't buy it. In Melbourne, median price for a 1-bedroom unit remained flat over the year, $395 as the city was kept in lockdown for many months. Thanks to Dan Andrews. Thanks, mate. You're a legend. I'll love to, anyway, I won't say much more. Yay. Serenity now. By comparison, midpoint house prices in the same city rose 18.6% to 1,100,000 in Melbourne. So imagine that. You buy a one-bedder in I don't know, Ormond McKinnon, next to the shops, fantastic. Rents really well. No problem with renting, and they will rent very quickly because a lot of students, a lot of single people, no problem, but very low capital growth. It's all about capital growth, guys. So you're missing out on that growth of 18.6% versus virtually nothing. Apartments generally had still a good, so with 2 bedders, 4.5%, 606. Yeah, the average bedder, depending on, if you're buying a 2-bedroom, always have 2 bathrooms. Never buy 2-bedroom, 1 bathroom, okay? Because then you have 2 people in 2 bedrooms sharing the bathroom and your guests are sharing the bathroom as well. So that bathroom is going to be a disaster zone. What you really want is 2 bathrooms, okay? 1 per bedroom. And the best scenario is 2 bathrooms and a toilet for the guests as well, separate. Larger 3-bedroom units did better throughout, the values rising 12.1% over the year to 846,000. So now is a really good time to buy 3-bedroom apartments. I hate Docklands and South Bank in terms of capital growth potential. I think it's a disaster. Now is the best time to buy a 3-bedroom, only 3-bedroom apartment in Docklands and South Bank. It's the cheapest point you're going to see in the gut feeling in the market. We're right at the bottom. It's about to turn. So if you ever wanted to get Docklands and South Bank for lifestyle, and I think for lifestyle, it's a great area to live in, okay? For investing, disaster. It's zero capital growth, probably negative. But for lifestyle, if you like the city, if you're retired, you want to go to The opera plays, the arts centre, it's got everything. Casino, fantastic views over the water. I get it completely. It's super cool, right? And a lot of those towers have really cool gyms. They've got cinema rooms. It's fantastic, right? But for capital growth, disaster. So once again, I'm separating the two. But now, guys, if you want to get into a 3-bedroom, not a 2-bedroom, but a 3-bedroom, this is the time to buy them, because I've seen them sell from $750 to $850 for 3-bedders in Docklands and South Bank. And they should be about 1.1, you know, for a 3-bedroom property. So really, you're never going to see a cheaper price point in the next, well, I don't think ever, because they're just going to go up from here by inflation, if anything. See, with high inflation, that puts pressure on all properties because of cost of construction goes up, labour cost goes up. So inflation is going to drag up property prices. The best thing for capital growth is inflation. And we've just had a massive surge in inflation in Australia, which is really good for those who are holding on to properties. The gap between houses and Melbourne apartments has become wider and wider. People don't like living in apartments. There's a lot of land in Australia, especially during COVID-19. People were trapped in apartments in little balconies, where those with massive backyards, they were living relatively, you know, unaffected. So people value space, people value backyards, people value townhouses with courtyards. And this is why the sentiment has turned against apartments more so now than ever. And we can see the gap between apartments and detached houses getting wider and wider. And you can see that now it's 52.4%, where it used to be 20%. It used to be very comparable to like a 2-bedder, used to be very similar to a detached house, you know, in key areas. Now it's virtually 52.4%, and that's going to increase even more and more. So my advice is just don't worry about apartments at all, unless you need to live there. I get it, you know. Apartments, bad, okay? Stay away from apartments. Stay away from them like a Tina Arena concert. House and land estates. There's more bullshit and lies in house and land marketing that I've ever seen in any industry in my whole life. The amount of rubbish that they write in those brochures and pamphlets, it's incredible that the authorities haven't shut these companies down. And these are legitimate big companies. It's unbelievable, you know. It's beyond me how the regulators don't jump onto this rubbish that I keep reading about this house and land estates. There's no growth in house and land estates, guys. There's no growth there. They're like Telstra shares. It's infinite supply purchased by low-income earners. By definition, it can't be growing in value. By definition, capital growth is scarcity of stock and demand by high-income earners, right? These so-called growth corridors are a complete disaster in Melbourne. So Melbourne is geographically landlocked here. This is basically got the Dandenong Ranges here, so you can't build properties over here. Over here, you can go to New South Wales and to Adelaide. So what we have is we have these capital growth, so-called growth corridors. Now the growth corridors, because they are growing in terms of build volume, but there's no capital growth there. The problem is you have massive unemployment. The red sections represent the most risk of unemployment, right? And what happens with unemployment? People lose their jobs, they can't pay their mortgage. So the dark blue is the lowest risk of unemployment. So if you're an investor, you're buying a property, you're going in $1 million mortgage, think about it. You're putting your whole financial future on the line and your family's future on the line. Do you want to buy in an area where there's virtually no unemployment, or do you want to buy in the highest unemployment area in Melbourne, which is all the new growth corridors? This is government data, by the way. I don't sit there at home with a crayon, you know, drawing in, packing them in red or Point Cook, guys. This is government data. Homicide. Where are all the gangs, all the drive-bys, all the stabbings, all the home invasions? You know, they're not in Toorak. Right? There's no story on last night a stabbing in Toorak where a dentist stabbed a doctor with an antique Louis V sword, right? It's always a stabbing last night in St. Albans, a stabbing last night in Frankston North, a stabbing last, you know, it's always the same suburbs, isn't it? Dandenong. It's always the same areas. Low socioeconomic demographics have a propensity to have a higher crime rate. I'm not saying they're all criminals, okay? I'm just saying it's a statistical fact that there's more crime in the lower socioeconomic demographic areas and in cheaper suburbs. It's a fact. Now, what does that mean? Is that a good thing or a bad thing for an investor? Well, the thing is, if you have a lot of people on the dole losing jobs and there's more pressure on properties and they're going to get fire sold or repossessed, that could devalue your property. The other issue is the chance of your property getting damaged and viciously damaged by your tenants. So if you look at, for example, insurance payouts, the most damaged properties in Melbourne are 4-bedroom new house and land estates, where the rental's $350 to $450 per week. You're never going to see a townhouse in Brighton East where they're paying $1,500 a week, all right? She's a lawyer and he's an architect, and they've rented the property and now the lease is expired, and just before they move out, they go around bashing holes in the wall and destroying the kitchen and rip out the toilet. Would they do that? Seriously. It's never happened, right? Does that happen in Point Cook, Trigonina, or all the other estates, Berwick-Pakenham? Absolutely, it happens all the time, If you don't believe me, guys, I'll put you in contact with property managers that look after hundreds of those properties, and when they're doing an insurance claim, I'll get you to go out on the road with them and you can go through these properties with them when they're taking all the photos for the insurance company. Just give me a call, no problem. So people always feel like, oh, you're just judging people where they live. No, I'm just saying it's all about making money. When you're investing, you've got to be discerning. You've got to be aware of these things because these factors can make or break your portfolio. So once again, high crime rates, not a good thing. 6 reasons why house and land packages underperform, and they will consistently underperform unless these things are addressed. Number 1, a dominant low socioeconomic demographic. The buy and reside in these areas tend to result in high crime levels, high levels of domestic violence, high levels of home burglaries and theft, higher cases of road rage, gangs and violence. It's a fact. Watch Current Affairs today, tonight. It's all there. Number 2, social issues associated with isolation, lack of community, resulting in high levels of depression due to dominant low socioeconomic demographic prevailing in these types of suburbs. People are scared, they lock the doors, they don't interact with the neighbours, so people feel isolated, there's no community feeling. When I lived in Balmoral, it was one of the nicest suburbs for communities. You walk in the morning, everyone says hello. You go to cafes, they remember you. You go to Concourse, that street there where everyone hangs out on Saturday morning, they have breakfast, people see, hello, how are you going? There's a real community feeling. Everyone is kind of, friendly. That doesn't happen in some suburbs. I won't mention names. And people will pay a premium to be in those areas. People will pay a premium to be safe. Lack of government planning and spending around transport accessibility job centres and Melbourne's central business district, resulting in transport stress, whereby residents are stuck in cars or, traditional trains and public transport for up to 4 hours per day, 2 hours each way. Packing them back to the city and back, it could be 2 hours, with delays by car. It's crazy. Monash Freeway is a joke, I mean, they've been renovating and extending that bloody thing for the last 20 years. I'm 45. They were extending it when I got my driver's license. They're still extending it. They should have just done 4 lanes from day one. Why would you build something with 2 lanes and then go, do you think Melbourne population is going to grow in the future? I don't know. Let's just do 2 lanes. Oh, you know what? We should do 3. So now let's close it up and do 3 lanes. Once you finish the 3 lanes, why don't we go back and do 4? We should have really done 4 at the beginning. Yeah. So let's just disrupt everyone for 20 years. It's a complete disaster, right? But this comes down to government planning, a lack of shopping strips, parks and amenities. Like Centre Road, Bentley probably is, in my opinion, the best shopping strip in Melbourne. You could argue, Moonee Ponds has, that strip there. You can say Fitzroy Street, St Kilda, or you could say, Carlisle Street, Balaclava. But to me, Centre Road, Bentley, those 3 Ks of shops are probably the best shopping experience in Melbourne. In fact, most people that live in Brighton East go to Centre Road, Bentley to shop. And people will pay a premium to be located close to those shops for convenience and safety and security. Unfortunately, you can't replicate that in a new estate. In new estates, you have those drive-up shopping centres that are completely dysfunctional. You either have those shitty little shopping centres where there's like 50 shops, you know, where there's a massive car park and everyone just tries to get in there and get out and then everyone's angry. Or you go to the big monstrosities where you spend half a day inside, trapped, you know, shopping. But they're not really functional. They're not as good as going down to, you know, places like in Brunswick as well, Sydney Road, for example, or Centre Road in Bentley. Average to bad, low-ranking primary schools and secondary schools. The schools are bad in those areas. New estates do not have good schools. Okay, all the schools are in the best suburbs in Melbourne. That's why they are the best suburbs in Melbourne, or one of the contributing factors. School zones are okay, but most new estates suffer massively in terms of how bad the schools are. And this is another reason why there's no real need for people to push up prices in those areas, because there's no schools in those suburbs. Adequate access to medical clinics and hospitals is another issue. People in most new estates have to go back to the city to get adequate medical, treatment for the kids. I mean, most of these medical clinics in the fringes of cities are a joke. This is 2022 mortgage stress. Have a look what they are. So I'm not making this stuff up, guys. This is Melbourne. Look at the dark patches which have the highest mortgage stress in Melbourne. Where are they located? Surprise, surprise, new house and land estates. Don't buy in areas with high mortgage stress, my advice. The other problem is there's infinite supply. Now, these companies here are publicly listed companies, right? And they hold this data is a little bit old. I can't get the new data anywhere. I could, but I'm too lazy to actually source it. But you can see there, Sunland, for example, or FKP owns 6,500 brand new blocks of land, which is 14 years of supply in new estates. So altogether, these developers that predominantly build in new house and land estates in Melbourne hold 250,000 blocks of land that they can release tomorrow and flood the market, which they wouldn't, obviously. They're going to be strategically released. So the problem is there's no end of supply. It's infinite supply, right? That's the issue. And the issue is it creates lower capital growth potential. Melbourne's richest and poorest suburbs. So one of the determining factor is, if I had one thing to look for in terms of capital growth potential, this is what I would do. Where are the most 10 advantaged suburbs in Melbourne? Advantage is a broad term. Access to schools, health, transport, safety, prestige, etc., right? East Melbourne, number 1, Glen Iris, Surrey Hills, Canterbury, Toorak, Brighton, Ivanhoe East, Eaglemont, South Yarra West, Camberwell, Balmoral, Albert Park. If you just invest in those 10 suburbs in Melbourne, you'll never lose money. You can't go wrong. That's it. Like, if you do nothing else, no research, and just stick to these suburbs and build your whole portfolio in these suburbs, you'll probably be more on track than 99% of all our investors out there. These are the worst areas these are the areas I would never invest in, no matter what happens. Broadmeadows, Corio, Campbellfield, Morwell, Breeside, Doveton, Meadow Heights, right? St Albans. A stabbing last night in St Albans. A drive-by last night in St Albans. Road rage last night in Broadmeadows. It's not road rage last night in Kew, where a father in a Mercedes-Benz attacked another father in a Bentley, right? Townhouses are your number one vehicle to making money because, unfortunately, most people can't get into these suburbs with detached houses because the price is number one. Number two is the rental yield is low, 2%. It's unsustainable. You'll be putting in hundreds of dollars out of pocket per week. Land tax is a killer because you're buying land. So you can't really, unless you're in a high income, a lot of these top suburbs, you can't really afford to buy houses. Now, I have clients that can buy houses and they have purchased houses in these areas for investment and they're getting $2,000 to $3,000 a week in rental. And I source properties for these clients in places like Toorak and Brighton and those high-end properties, and they're getting $3,000 a week rental. Townhouses are the best option because they give you the suburb and the brand, but at a fraction of the cost. but more importantly, with a higher rental yield. Your rental yield is around 4%, 4.5%, so it's cash flow positive. So if you look at, and this is the thing about buying old houses versus townhouses. A lot of people say to me, well, I want to buy an older house because land goes up and buildings depreciate. That's true, but that's not the question you should be asking. And here's the thing, guys. The difference between the rich and the poor, and this is a very key fundamental difference that I've observed over the years, is that the rich have learned how to ask better value questions. So if you're buying a property, the question shouldn't be, what's the best performing property that I can afford to settle? That's a good question, but it's not the number one question. Because what if it's the only one you're ever going to buy? And this is why 73% of all investors only own one property, because they buy a property comparable to what they live in. They live in Bentley in a $1.2 million house, so they go to Moorabbin and buy a house for $1 million, and they never go to a property number 2 or 3 or 4, right? Because it's killing them. Land tax is killing them, low rental yield, no depreciation. So what you're better off doing is buying Bentley townhouses that are cash flow positive from day one with high depreciation. So the question shouldn't be, what's the highest performing property that I can buy? It's, what's the property where I can buy 7 of them in over 10 years and replace my income? And the answer isn't an old house on a big block. It's mathematically impossible for the average income earner, let's say on 80 to 100 grand, to do that, okay? That ship has sailed. So the only option you have is really a townhouse. Now, in terms of townhouses versus old houses is this. Yes, the house will outperform the townhouse, okay? Let's say $1 million townhouse versus $1 million house where this is a big block of 650 square meters and this is 150. This will outperform this in the same suburb. Absolutely agree. But you can't buy 10 of these. Mathematically, it's impossible, but you can buy a lot of these. I don't know how many because I don't know what your income is and your tax. The difference is this. Most of these old houses, it's all land value, so you're paying a lot of land tax, 3, 4, 5, 6, 7 grand a year. They've got a 3-bedroom, 1 bath, 1-car garage. Therefore, very low rental yield, 2.25. So $450 a week, $435, $22,500 annual rent. Limited deductions because the building is already 40 years old. There's no depreciation on the building. There's no depreciation on fixtures and fittings. So you're not getting that 10, 15 grand back from the ATO every year, okay? With townhouses, yes, if this is doing 10%, this is doing 7%, but your land tax is a fraction. Because remember, now you've got, how many of these do you have to make up one of these blocks? You know? How many? Do the numbers. 4, right? 4-bedroom, 3-bathroom, double-car garage. So you get a higher rental yield, 4.5, 4%, 800, 750 a week rental, 45 grand per year, maximum deductions, which means more money back from the ATO. And you also have the maintenance is minimum because everything's brand new. 7-year building warranty, appliances, having all the manufacturer's warranties. So what you want to do is buy an asset that's basically costing you nothing from day one, putting money in your pocket and allowing you to buy multiple assets over time. So remember, if something is growing at 10%, $1 million at 10% is $100,000 for the year. But if you're controlling $5 million growing at 7%, okay, $5 million, you're making $350,000 rather than $100,000. So the more you own of the asset, the better off you are. The quicker you get to your outcome, which is for most people replacing their income or building their equity position. So property prices will rise a further 10% in 22. This is from some projections from REI groups and different people. I think the market's going to do 12 to 15% in Melbourne. See, at the moment, we had a correction, and what happens is after every economic, or it doesn't have to be economic, it could be a virus, it could be an abnormality, I guess, in the world, global economy, and in the environment. Every time we had a dip in the market, it's followed by a boom in the property market. Okay, so every time we had the Asian currency crisis in 2000, it was followed by an upward market. Then we had the dot-com bubble bursting, which is an event. We had a massive rise in the real estate market. GFC, we had massive boom in the property market. I was telling people in 2008 to buy property. 2008, I was speaking all around Australia saying buy Port Melbourne, buy Elwood now. Hawthorne, those areas. And if you did, you would have tripled your money. China glut still 2015, property boom. Now, COVID-19, property boom for the next 3 or 4 years. What suburbs represent the best value for money now in 22? So this is the funny thing. I'm going to play you a clip now from September the 22nd, 2019, where I made a prediction about which areas are going to boom in Melbourne. Okay, so this is during COVID, and this is my predictions about which suburbs are going to boom. Let's watch it now. What's the best undervalued long-term high-growth suburb to target in Melbourne? In my opinion, if it's upmarket, if it's in a higher percentage price point, Albert Park. So if you've got a lot of money, you can buy, say you can spend 1.2 to 1.7. Albert Park, Port Melbourne, St Kilda, East West Balaclava, Brighton, Bentley East, Elwood, Hampton, Sandringham, Blackrock, Balmoral. Entry level. So these are townhouses we can get in for, let's say 850, 950, 1 million. Cheltenham, Hyatt, Mentone, Morialek, Aspendale, Edithvale, Chelsea, Bonbeach, Chelsea Heights, Carrum. Don't go to Seaford, guys. Seaford doesn't work. Okay, and forget about Frankston. I've been hearing about Frankston for 20 years how it's going to boom, and I'm 44, okay? Frankston won't happen, so move on, okay? It's not going to happen. What about Frankston? Upmarket eastern suburbs, Mont Albert North, Kew, Canterbury, Camberwell, Surrey Hills, Hawthorn, Balwyn North, Glenwaverley. These are the highest growth suburbs, in my opinion, for the next 2 years after the COVID-19 recovery, which could happen this year or could happen next year. I don't know how many breakouts we're going to have. There could be another breakout. Entry level, so 800,000 for townhouses, 900, 1.1. Box Hill North, Heidelberg Heights especially, really cheap, and I'll talk about that in a second. Blackburn, Burwood East, Mitcham, Bayswater, Doncaster East. Amazing, wasn't it? How right was I? Look at the predictions here. Once again, the best suburbs to buy into: Albert Park, Port Melbourne, St Kilda, East West Balaclava, Brighton, Bentley East, Elwood, Hampton, Sandringham, Blackrock, Balmoral. All in the Bayside, right? And all did extremely well. This is the results. Blackrock, right? So if you look at all my recommendations, number 9 was Blackrock. Now what happened today? Blackrock did 30%. Mentone, 29.6. Frankston South, 29.4. Morialek, 25.7. Albert Park, 24%. Albert Park, 24%. My number 1 recommendation. During COVID-19, when everyone was saying the market's going to crash, right? All the politicians, everyone, oh, the market's going to crash because unemployment, people are leaving Melbourne, all this bullshit. Carrum, 892,500, 19.8. Parkdale, 19.7. Balmoral, 19.2. Frankston, 18.8. Seaford, see, I wouldn't even invest in Seaford. I can't believe it went up by 18.5%. St Kilda, 16.9. Sandringham, 16.5. Aspendale, 15.1%. So when you're getting advice, look at the track record, guys. Go to my past videos on YouTube and look what I was saying and look what's happening right now. You know, and look at all the other people that were saying the market's going to crash. The amount of young kids there. Now I'm 45. I've been investing now for over 2 decades. I've been in the financial services sector since I was 21. That's 24 years in the industry, 25 nearly, right? Quarter of a century in the same market in Melbourne. Quarter of a century in the same market. I see these kids, 21, doing the YouTube channel on the property. I'm going, you're 21, dude. Like, you've only been around really, like, high-level awareness for 3 years since you're 18. You don't know anything about the property market. And all of them were saying the same thing. Bloodbath. The end of the Australian property market as we know it. Anyway, you get the picture. I feel like a broken record. So what suburbs in Melbourne represents the best value for money right now in 22? Morialek is very undervalued. So I'm sourcing properties in Morialek. It's great, it's beachy, it's cheap. It was always the cheapest suburb in that kind of part of the world because Aspendale is very expensive now. So you've got Aspendale, Edithvale, Chelsea, Bond Beach, but Morialek has got all the shops, but it's affordable. You can get a 4-bedroom townhouse for $1 million, you know, cash flow positive from day one. So I'm sourcing all the time in Morialek. This is a typical configuration. I mean, they vary from project to project. So if you're interested, just email me or call me and I'll give you the latest updates on availability. Double garage, bedroom downstairs with an ensuite, powder room. So this is a good scenario. You can have your Zoom room downstairs. If you're working from home as an accountant or mortgage broker, you can kind of see clients nearly from downstairs without them going into your living area. Then you've got your living area, dining area, bedroom, kitchen, bathroom for the bedroom plus for the guests. Then upstairs you have 2 bedrooms with a breakout room and with a bath. So it's a really good property, 213 square meters or 22.95 squares, $1 million cash flow positive from day one. Oakley South. Guys, Monash Clayton, okay, which is a monstrosity of a campus. And I used to do my research there. I was at Monash Caulfield, but I used to go to Monash Clayton to use the library because they've got the best library at Monash University in Victoria. There is a critical rental shortage right now in Monash, in the Clayton area. If you look up Oakley South, Clayton, go to realestate.com, type in townhouses and houses, and look how many are in the market, 5, 10, 15. What will happen next year when those 12,000 kids will come from Asia to do all the university degrees? Where are they going to be renting? I have no idea. So it's just, there's no stock on the market. I don't even know where they're going to be living, you know? So to me, if you want really high cash flow, positive scenario in Melbourne and get good capital growth, because let's face it, Oakley South, boring suburbia, okay? We're not talking, there's nothing cool about Oakley South. It's just, Oakley's cool, right? Oakley's got all the cafes and restaurants, and the Greeks have really turned that suburb into an amazing area. My wife's Italian, I'm Polish, I've got a lot of Greek friends, so we go there on Saturday nights for dinner all the time, and I catch up with friends there, developers during the day for lunches. So it's a great suburb, you know, to invest in, but Oakley is very expensive now. Even the rental yields haven't come up, but just the value of the property is very expensive to get into. Oakley South, semi-industrial, you know, the cheaper part of it's cheaper, much cheaper, but you've got this Monash University campus. This project was amazing, 96 properties. Majority of these were houses for 1.3 million. So I was mainly focusing on these townhouses. There were 835,000, 840,000, 3-bedroom, some were 4-bedroom. Once again, just builder's range, okay, nothing special. You don't want to overcapitalize on these properties because you won't get the rental back, but very clean, very, very efficient in terms of energy ratings. They rent very quickly. The level of fixtures and fittings, even though it's builder's range, looks amazing. You know, these tiles, even these fixtures and fittings, I mean, they look from 10 years ago high spec, but they're now just entry level. So really good. There's the location of the development. There's Monash Clayton and there's Monash Medical Centre. So your number one tenants would be doctors, nurses, first year doctors, or teachers at Monash University. Never rent to students, guys. Never rent to students. They'll destroy your property, okay? So forget about students. Very good location, and there's going to be a massive critical shortage of rental properties. So look up Notting Hill, look up Clayton North, Clayton, Oakley South. There's virtually nothing on the market. Capital growth for townhouses in the area, 11.32% for the last 12 months versus 5.34% for houses. See, houses are underperformed there because they're the older houses from the 80s and 70s, very tired looking, you know, 1 bathroom, 3 bedrooms. No one wants those properties unless you're going to renovate them or extend them or redevelop them. Townhouses is what everyone wants. Brand new kitchens, new bathrooms, new appliances. Very good team. When you're doing research, guys, by the way, on a development, you see a lot of horror stories on current affairs, people going down. It's always these kind of backyard operators, one-man show. You know, you got some Croatian guy living in Coburg, you know, Mr. Milosevic, and then he runs off with people's money and then current affairs chasing him down the street. Mr. Milosevic, what do you say to those families that have lost everything? So what you want to do is you make sure the team behind the development is number one. So in this example, you have the property developer, a Southlink developer, which is a great developer, award-winning. The project manager is PDS Group. which manages the whole project. Then you got Balmain & Co as the builder, and then you got EAT Architecture. It's a winning team combination here. That's what you got to look for when you're buying properties off the plan. Who's behind the project? All those people that go down, it's always some guy working from home, stressed out with his home cross-collateralized against the project. So once again, with these properties, very cool. Tandem car park, double car park, bedroom downstairs with an ensuite. So you got a single car garage. You've got a carport off the street, open plan living, dining separate there. You've got a toilet, balcony, and then upstairs, 2 more bedrooms with 2 en suites, and with the master bedroom having a little balcony. So these properties are great for rental. You know, they're 170 square meters, rent very quickly when they're completed. It's a bit of a no-brainer. The larger ones, which are 1.3 million, are virtually houses, double lock-up garage, you know, living area, kitchen, dining, a meals area, courtyard, and then 4 bedrooms upstairs with 2 or 3 bathrooms, depending on the configuration. Now, there's only 8 properties left in that project as of this morning. 4 of them are 838,000, and then 7 properties left, and then these are 1.25, 1.3, 1.318, and that's it for the project. So if you're interested in Oakleigh South, if you watch this video, drop me an email and I will let you know what the availability is. This is a completed project in Sandringham. Sandringham is another area that I think has done exceedingly well. Blackrock Sandringham just killed it. It will continue to go up really fast. Great property, once again, completed. These are a variety of different townhouses. They range between 1.4 million to 1.89 million. So very good configuration. This property here is, so this is the larger one. And these also have lifts in them as well, which is good for depreciation and good for elderly people who don't want to walk upstairs. So these are 3 and 4 bedders that are available as well. If you're interested, definitely let me know. Finally, in terms of affordability and suburbs that are going through gentrification, I thought I mentioned Heidelberg West and Heidelberg Heights. You probably would have seen me before on some other videos mention these suburbs. I think they're really good. They're undervalued. The story is really good because it's basically an ex-housing commission area, which is Heidelberg Heights and West, surrounded by very good blue chip suburbs. Now, imagine the cities here. Normally when you have a suburb that's going through gentrification, as you get beyond the suburb, it becomes worse and worse. But in this instance, the suburbs that are further away from the city are actually blue chip, which is Heidelberg, Eaglemont, Ivanhoe, Rosanna. These are very expensive suburbs. We can spend $2 or $3 million for the average house. So this little pocket here is going through gentrification. This is the problem. These houses here that were built by the government, they virtually cannot be renovated or restored. They've got to be ripped down and redeveloped into brand new townhouses. You know, there's no value in these properties at all. And that's what they look like. That's what the original housing commission units look like in Heidelberg Heights and West. This is the project that I've just sourced in Heidelberg West, 695 to 895, to only 4 townhouses in this project. Once again, all builders range. Very good level of fixtures and fittings. Very well located, just there, opposite a park. And then you're tapping into the surrounding suburbs, as well as the Austin Hospital and the hospital precinct, which is just here, where you've got thousands of medical professionals working. So you're targeting the first-year doctor, the nurse, the medical specialist as your tenant. The area has done 13.2% in the last 12 months. Long-term average, I would say 8%, realistically speaking. You know, what we've seen the last 3 years, guys, isn't sustainable long-term. People got to understand that this market will go back to its average capital growth. But definitely this is something you can work with. Only 4 townhouses, you know, and they vary from very traditional kind of double lock-up garage, open plan living area, and then upstairs you got 3 bedrooms, the living area, and 2 bathrooms. And you also have your 2-bedroom single-car garage configuration, as well as the larger 4-bedroom double lock-up garage configuration at number 4. So once again, these ones here range from $695,000 up to $895,000 for the 4-bedder. So if you're interested, definitely give me a call. or drop me an email. I can send you the availability. Hope you enjoyed the video today, guys. I went over time a little bit. In terms of what's the next step, if you want to have a consultation with myself, if you feel like building your wealth through townhouses in the blue chip suburbs is your thing, and look, they are getting expensive, guys. I'm not going to lie to you. So you have to have a bit of an income as well, and I'll cover that in a second. But I can definitely do a plan for you and a strategy to show you how you can replace your income in 5, 10, 15 years, depending on how much equity and how much income you're earning. It's no obligation. It's 60 minutes. It's via Zoom. And I'll do a complete plan for you. I'll go through your current situation and work out where you want, where you are currently, where you want to be, and give you feedback about what's possible. Remember, failing to plan is planning to fail. It's always good to start these things. The sooner you start, the more options you'll be aware of. And what I do in my consultation is, most people, what they do is from point A to point B, is they do this, where with this consultation, basically it's the path of least resistance. So in the 1 hour strategy with myself, you walk away with a clear understanding of your strategies, actions you need to take to bridge the gap between where you are and your financial objectives. You get a personalised introduction to your whole team. So one of the secrets of making money is getting a whole team of experts around you. Accountants, mortgage strategists, financial planners, and I've got the best team in Melbourne. You're more than welcome to use them. I use them personally for my wealth and building my property portfolio. So I'm happy to share those names with you. And also you get priority access to my developments as well. Just having a session and getting a team together is worth your time. I mean, it's just crazy. These people it took me decades to find some of these experts, and they are literally the best in the industry, right down to property management, building inspections, insurance brokers. I know them all. I know the best in the industry. I deal with them every day, through my clients, for my clients personally. So it's a journey of building wealth through property, and it's a very succinct strategy. It's step by step. There's no real guesswork involved. It's a system like anything else. There's no magic guides. It's just mathematics. It's formulas, algorithms, pre-approval, and then you just buy properties. In order to qualify for the consultation, if you're a single person, you need to be on about 95, 100 grand a year, because my cheapest properties that I'm sourcing are 700,000 for 2-bedders. So you really need to get into something that's worth getting into now in Melbourne, and that is expensive. It's $700,000. So you kind of need to be in that 95 kind of income. If you're a couple, kind of 80 and 60, so kind of 140 grand with a bit of equity, around 112,000 equity, you can get into your first townhouse. And obviously the more you have, the better properties you can buy. So these are kind of targeting the 750 plus purchase. So if you're interested, you can do one of two things. If you have come to a live event in the past, you have this form with you, just fill that out, send it to me. Or you can just email me directly, conrad@investorsprime.com.au, and request a free consultation with me. Just put free consultation request in the headline with your details, and I'll send you my availability, and we can book a call and then have a chat. Thank you guys, it's been great. This is Conrad Bobulak, and I'll see you on the inside.